Ladies and gentlemen, good day and thank you for standing by. Welcome to the Linde First Quarter 2026 Earnings Call and Webcast. At this time, all participants are in a listen-only mode. Please be advised that today's conference is being recorded, and after the speaker's presentation, there will be a question-and-answer session. I would now like to hand the conference over to Mr. Juan Peláez, Head of Investor Relations. Please go ahead, sir.
Abby, thank you. Good morning, everyone, and thanks for attending our 2026 first quarter earnings call and webcast. I'm Juan Peláez, Head of Investor Relations, and I'm joined this morning by Matt White, Chief Financial Officer. Today's presentation materials are available on our website at linde.com in the investor section. Please read the forward-looking statement disclosure on page 2 of the slides and note that it applies to all statements made during this teleconference. The reconciliations of the adjusted numbers are in the appendix to this presentation. Matt will provide some opening remarks. I'll give an update on Linde's first quarter financial performance, and then Matt will finish the updated outlook, after which we will wrap up with Q&A.
of why when Europe was flat, Asia down. Is it helium? Is it the rapid cost inflation in March, which created the temporary squeeze? Any help there would be very helpful.
Sure, Laurent. I'll start with, and we said this last time, and I just want to reiterate it again this time. On a full year basis, we feel pretty confident. We're not only going to raise margins for the full year 2026, but probably at the upper end or even above our traditional range that we tend to talk about of 40 to 60 basis points. Now, stating that on the full year, you're always going to have some moving parts within the quarters. I think when you think about Europe, clearly the volume is a bit of a drag. I think within EMEA as a whole, we mentioned on the call between a combination of the overall weaker industrial environment, weaker chemicals environment, add to it both direct and indirect impacts from the current Middle East conflict. We're just not seeing the volume recovery there. But I could tell you we're not happy with the performance. The business team is taking actions to improve that. They know that. So I expect to see some improvements there in Europe. With APAC, we did mention on the backup slides, we had about half of the sales growth was a sale of equipment. That actually is equipment that is connected to long-term merchant contracts and electronics. So that does come with future contracted merchant sales, but that'll tend to be a little bit lower margin on average. It's a kind of a one-off. But also, as you know, Q1 is traditionally weaker in APAC, just given some of the seasonality effects. So I expect APAC to kind of get back up to the 29% margins we saw last year as the team there continues to work towards improving that. So some of it's timing, some of it's just a little bit of some effects on the volume. But on the full year, we fully expect to not only raise margins, but probably the top end or above. And again, this is all ex pass-through, up or down, as you know, which is just more optics on the margin and no real effect to profit dollars.
Sure, thank you. And as a follow-up, you mentioned that you would disclose commercial space sales when you get to 5% of the group, which is about $1.7 billion. And I think recently, or on a prior call, you mentioned that you thought sales in commercial space would get to about $1 billion by the end of the decade. So I'm just wondering, are you now thinking that we may get closer to $1.7 billion by the end of the decade? It's a big change.
Yeah, so Laurent, I'll start with, look, we feel very good about our positioning to support the space economy and as that develops. Clearly in the US, you're seeing that much more rapidly with the private commercial space sector. But even across outside the US, we're definitely seeing acceleration in those efforts. With controlling the customers, that's going to be their determination on launch. But it's like I mentioned on the call, it's going to be a function of frequency, size, and propellant type. And what that means, I think frequency is self-evident, how many launches occur. With size, it can be dramatically different. Much larger rockets and much larger booster systems can use orders of magnitude higher of propellant. As you can imagine, something, for example, the largest rockets out there versus the smaller ones, you could see 10x difference on fuel and propellant. And then the fuel or propellant type is important because while we supply oxygen for the oxidizer and nitrogen for densification, fuel-wise, there's really three types today. You'll see, which is either kerosene, methane, or hydrogen. Obviously, we supply hydrogen. We do not supply the other two. We would do only sale of equipment for things like LNG. And so if you do see more hydrogen-based rockets, that could also accelerate the growth for us, depending on the fuel type used. So we feel pretty good about it. You look at the ambition on getting satellites and constellations in space today. You look at the existing population and what needs to be replaced in low Earth orbit roughly every 5 years. I think it continues to bode well for launch. And not only the major players, but there's more room for maybe some new players that can be supporting the demand out there to get more constellations in space. So we'll see where it ends up. I think it will all be a function of the launch cadence, but we feel quite good about our positioning to supply that when it happens.
Okay, thank you.
And our next question comes from the line of Patrick Cunningham with Citi. Your line is open.
Hi, good morning. Thanks for taking my question. I guess first, as you think of maybe the longer term implications of this crisis. It seems like there's probably a heightened focus on energy security, deglobalization. So I'm curious as how you're thinking about the potential for how potential conventional energy and energy transition projects should trend as a result.
Yeah, thanks, Patrick. I mean, the natural reaction is exactly like you stated, right? Energy independence will be more accelerated. One can argue we've already been deglobalizing as a global economy, and this may have accelerated some of that. But energy security continues to get a lot of highlight and spotlight when you see these supply type shocks that occur. But my opinion, ultimately, it still comes down to economics and ability. So while renewable energy will continue to be an area of high interest, it's still going to require government intervention. It'll require some support, sponsorship, potentially some kind of subsidies, as we've seen in certain geographies. And so I think without that, it's hard to see that happen on its own, as we've seen, but time will tell. I think as far as other hydrocarbons, I absolutely believe you'll see more of that. Clearly with other LNG in areas that are probably less of concern countries, you could see areas like oil sands of Canada become more interesting again, just given that the exploration risk is almost non-existent. They know the product is there. It's just more of a logistics challenge to get it seaborne or to get it, piped to where it's needed. So I just think that some of the more traditional areas will get another hard look given the uncertainties in the hydrocarbon space. I do think you'll get renewed interest in renewables, but again, without the support of government to help that on everything from right-of-ways to land to permitting to bridging some of the economics, it'll be hard to see that accelerate at a clip that people want it to.
Got it. And just on European, sort of outlook, how should we think about on-site volumes and potential earnings upside for the balance of the year? I think despite some of the feedstock and energy challenges, we have heard some more advantaged or flexible refining and petchem assets, running a bit harder sort of month to date. So how do you square that with sort of the outlook? What are sort of the puts and takes in terms of mix there as well?
Sure. I think we do have some on-sites that are running well that you could argue are state champions or regional champions. But on the flip side, we've definitely seen some shift production, right? And they're shifting into some of the assets we supply in other geographies, primarily in Americas. I do think part of it also, in Europe right now, in my opinion, you have a bit of a challenge with some of the uncertainties, right, around energy policy, around some of the environmental policy. Clearly, there's a lot of imports, and not just on the base material sides, but on the finished goods sides as well. And so at this point, it's hard to see how all of those factors will create any significant change without some catalyst. And whether that catalyst is some type of restrictive import policy or more clarity on the environmental policy, clearly with the IAA, that could help. I think it just needs that money needs to find its way on the ground. If it does, that could help turn some of that around. So that's, to me, what we just need to see. If we see a catalyst there of some significant type, it should help. And it could be anywhere from maybe some import restrictions to the IAA hitting the ground. But aside from that, it's hard to see a major shift.
Great. Thank you so much.
And our next question comes from the line of Vincent Andrews with Morgan Stanley. Your line is open.
Thank you and good morning. Matt, circling back on the space side of the equation and the idea of getting to that 5% of sales. Do you have the capacity you need to get there, or should we be anticipating some type of capacity increase? Maybe it's in different geographies. And would you do that in concert with customers, or would you do that on your own and make it more of a merchant business? How should we be thinking about that?
Yeah, sure. I think it's really in concert with customers. In my opinion, you have several launch providers that are doing a variety of different engine testing. They could do static testing, gimbal testing, whatever they're doing. And the locations they want to do that could very well be different than where their pad is, where they'll launch. Once they start migrating to more frequent launches, which can migrate from, wet dress rehearsals all the way to full launch, you're going to want to make sure logistically you're as close to the pad as you can be. So from my perspective, we are working with the major launch providers and also a lot of the up-and-coming providers to make sure that we have the capacity and the contractual relationships to support them and their ambition. And the way it kind of works is, in the early stages, you're probably going to do longer logistics hauls when it's more infrequent and intermittent. And then as they get onto a better cadence, then you start talking about new requirements contracts in supporting a more stable launch cycle. And that you put closer. And so you eliminate the logistics costs, which obviously makes their costs lower on the propellant. And it's a combination. It'll be sale of gas, obviously. It also could be some sale of plant. We do both. We support. It's very similar to what you would see in the large on-site, where at times we've sold plants and sale of gas, and we'd literally run the system of all the plants. So I think that's what you're seeing. And as you can imagine, there are some very specific areas where the launch sites are concentrated, given FAA regs and what you need to do around that for the airspace. And so that's where we have a very strong capacity today, and we're working to secure more contracts with our customers for the future launch needs.
Thank you.
And our next question comes from the line of Duffy Fisher with Goldman Sachs. Your line is open.
Yeah, good morning, guys. By far, the most incoming questions I'm getting on you guys is around helium. And I know you guys talk about it being kind of a small part of your business, but in the last supply shock we had with Russia, you did see pricing start to roll into some of the contractual business. I guess, how do you see this supply shock playing out differently than what the Russian supply shock did? And how long would the strait have to be closed before you'd start to see some of that pricing roll through some of your contractual business?
Sure, Duffy. Yeah, maybe I can level set it with what are we seeing in helium in the first quarter. So I'll start with our helium business. Depending on the time, we're anywhere from 85 to 90% contracted on our customer base. So that's kind of a starting point. And when I look at Q1 year over year, our global helium sales, for the most part, were roughly flat. And what we saw was a couple percentage decline in pricing year on year and a couple percentage increase on volumes year on year. Now, as you know, with the Iranian conflict, it sort of happened 2/3 into the quarter. So one can roughly argue you had kind of 2 months before and 1 month after, based on the date. And what we saw, we've been seeing the pricing rise on the average pricing. So even though we're a few percent below, pre and post that, there is a difference. And likely that price will continue to go up and roll its way through. I fully would anticipate that to happen throughout the year. Separately, our volumes are up, and we've actually already secured some long-term agreements. I fully expect we'll secure more long-term agreements. That is our priority. And that's how I would see that play out. Now, when you think about the helium situation, you have two sort of distinct issues happening at once. You obviously have the Strait of Hormuz with Qatar and their inability to get product out, and also the question of how much capacity is out for multi-years based on damage. Separate and distinct, you have this Russian issue going on, which is probably a little more political in nature. Now, we don't take Russian supplies, you can imagine, but that is having an effect primarily on the Chinese market. That one could fix itself much quicker, as you can imagine. And so that one, we'll see how long that lasts. But I think either way, the way we built the guidance, we just didn't want to take a view either way. We just left it as we had it. But when opportunity presents itself both on pricing and volume, that will be incremental. And that's something we will get above how this is guided today.
Terrific. Thank you, guys.
And our next question comes from the line of David Begleiter with Deutsche Bank. Your line is open.
Thank you. Good morning. Matt, on electronics, I know you're expecting a couple of large contracts this year. Are they still in progress on the come for for 2026?
Yeah, David. So consistent, yeah, with how the prepared remarks, we have a pretty high degree of confidence that we'll be announcing some here shortly. And when I think about the project backlog itself for sale of gas, we're sitting a little over $7 billion right now. And I'd look to these being added. And based on some timing of some other projects, I'd fully expect us to have a higher backlog by end.
tax, or do you have a different number?
Okay, so let's just take the second question first. On FX, the simple way to think about it is just take whatever we put in the sales variance. So in this case, we had the 5% globally.
Yep.
And that pretty much drops all the way down. That's sales, that's SG&A, that's operating income, that's EPS. Because of the way our business is structured, it's very localized. And so our exposure to sales on translation is quite similar to our exposure to costs. So 5% would be that impact. As far as other income, yeah, in the last few years, other income has been anywhere from 100 to 200 million. I would expect this year, for the full year, we'll be on the lower end of that range. And to sort of characterize what is there, right? It is operating income. It is part of operations. But we tend to put things there that usually are settlements, could be time lags, could be gains, losses on sales of things. So we put it there generally to isolate it so it doesn't get embedded into the sales and cost of goods sold from a trending perspective. So in this particular quarter, we had a gain on a sale. It was a cash gain. It was a real gain. But that basically created that. I don't expect very much in the next couple quarters, hence why I think the full year will probably be in the lower end of the range from the last couple of years.
Great. Thank you very much, Matt.
Yep.
And our next question comes from the line of John Roberts with Mizuho. Your line is open.
Thank you. Could I ask if Sanjeev is not available today, or is this the new format for the earnings calls?
So, John, yeah, if you may recall in the past, we've always kind of alternated, and sometimes Sanjeev would be on or Steve would be on or not, and Sanjeev would kind of evolve to that. So, no, he's not on today, but he'll definitely be on in a future call.
I wanted to make sure he knew he was missed. I'm a little confused about EMEA. I thought the shortages from the Persian Gulf conflict were so severe that Europe was actually going to have to run at higher rates. Even though it's higher cost, we're going to need most of the latent capacity in the world to run higher. And so it sounds like you're still expecting it to be soft in the June quarter in EMEA.
Well, let's start with, as you know, the guidance of what we said is no economic improvement at midpoint. So that's just the baseline based on the guidance. So if you take that and extend it out, what it's implying is what we're seeing in Q1 just continues going forward. Whether or not it improves, we'll see. But from what we experienced in our EMEA in Q1 on the onsite and chemicals and energy on a year-over-year basis, we saw a decline based on the effects from those operating assets of the customers.
Okay, thank you.
And our next question comes from the line of Kevin McCarthy, Vertical Research Partners. Your line is open.
Yes, thank you and good morning. Matt, just to follow up on the volume discussion, if I look at your Americas number of +2, I think that's the best that you've posted since the third quarter of 2022, which is coincidentally when we tend to think of the onset of the industrial recession, certainly in the chemicals industry anyway. So, I'm listening to you today talk about, hard goods up double digits, energy and chemicals trending for the better. Do you have enough confidence to say we're now on the cyclical upswing, or do you think there's too much war-related uncertainty and potential for an oil shock to start playing offense, if you will, in the Americas?
So, Kevin, I always remain a little guarded, right? I think I need to. But I sort of think about it as, we have an engine here with a few cylinders, right? And one cylinder is Americas, one is APAC, and one is EMEA. And we're not running on all three cylinders. So while the Americas, both results and trend, I think, are positive, we're just not seeing that in EMEA, for example, today. So I think to see a true, what I view as global recovery, I'd like to see all three running in the same direction. But time will tell how that ends up. But I feel in the Americas, and like you mentioned, the packaged gases, what we're seeing on some of the competitiveness in the U.S. Gulf Coast, that does include commercial space, as you know. We expect that to continue to post some pretty good numbers. As far as are there offsets to that or not elsewhere in the world? That's the challenge that we need to see to kind of break out of this and start to see global positive volume. So I will say, at the global basis, while we showed 1% global volume, which is mostly our project backlog contribution, we did turn positive on base volumes. It's just not positive enough to round to 1%, but it has started to turn positive. So we'll see if that trend continues and actually breaks out and rounds to a positive base volume. But right now, you're seeing puts and takes around the world, and we'll see if the comps lap to where that could be positive.
Thank you for that. And then I wanted to follow up on helium as well. I guess my simple question would be, how much incremental volume opportunity do you think may be available, again, through long-term contracts that you're pursuing? Maybe you could speak to your flexibility on sourcing and how much of an inventory cushion you may be able to take advantage of here.
Well, I mean, we feel good about our sourcing, and we feel good about our capability to not only meet our current customer contractual commitments, but that we would have some excess molecules and assets to be able to deliver to future new customers. As far as how much, it's really just going to be a function of the extension of this situation and where it goes. But we will be, selective. We want to make sure we get the right kind of contracts that make sense with the right kind of customers that we know will make that commitment to supply. So time will tell. I mean, we've already been able to sign a few new long-term commitments, and we'll just have to see how it plays out over the next several quarters.
All right. Thank you.
And our next question comes from the line of Lawrence Alexander with Jefferies. Your line is open.
So good morning. Two quick ones. Just first, are you seeing in any regions or significant delays in projects where you're seeing kind of the CapEx decisions at least get delayed, if not, even if the underlying the production rates are fairly stable? And secondly, if customers have to shut down capacity because of outages, because of feedstock supply issues, whether government mandated or just they can't get the molecules, your contracts don't give them any adjustment for that. I mean, they still need to pay you the same rate or pay the full exit penalty. Is that correct?
Okay, so first on the delays, just to segregate, in our backlog, no concern, right? What's in our project backlog right now is moving forward as expected. No concerns on that front. As far as potential new projects to be signed with customers' willingness to go to FID, essentially sign a contract, it depends on the end market. I would say, as you imagine, electronics, commercial space, you're seeing a continued very strong push to move forward with projects and investments. I think when you get to the more traditional industrial markets, it's really geographic specific right now. I think in the U.S., there are a lot of interest for future investments. I think places like India, you're seeing some good positive views, but in other parts of the world, not so much. So that's more of a geographic specific. As far as contracts, I mean, what it gets to is force majeure language. This has been something you focus on heavily in any contractual business. We've worked and tested our force majeure language over many, many decades. Economic is not a force majeure, as you can imagine. And so this is something that we always will work with our customers in these scenarios. But when we build these assets, we don't benefit when things go great. And in the same token, we don't take the downside when they don't. So from that perspective, we are well protected against any type of economic force majeure or other aspects of that. But it's really, something that's going to be a contract by contract review.
Thank you.
And our final question comes from the line of Arun Viswanathan with RBC Capital Markets. Your line is open.
Great. Thanks for taking my question. Congrats on the results. Just quick question on the earnings algorithm. So if I heard you correctly, it sounded like FX was maybe 5% contribution to Q1 of that 10% that you saw. you're guiding to 7%-9% for the year. So do you expect FX would continue to play that contribution for the year's EPS? And if you do fall short of your 10% goal, is there other actions you would consider getting up there, maybe increased buybacks or management actions or anything else that we should consider? Thanks.
So, Arun, I think with the algo, as you well know, we have the management actions, we have the capital allocation, we have the macro. If you just take the macro in isolation, yes, we put a 1% FX tailwind in the assumption. I will say, and as you probably well know, we base this number on sort of the first of month forwards, which is about a month old. Right now, spots are better. The foreign currency strengthened since that time. So that would provide FX upside if these spots remained. But we can set that aside. As far as the management actions and the capital allocation, look, we know we need to get back to that 8-12% range, excluding macro. I think we had a little bit of a drag, as you know, with helium for a period of time. We have about 1% or so drag just on the engineering business from its timing of projects, which is really more just a function of what is done as internal projects that's capitalized versus external projects for a profit. And so we got to get through those two, and I think that can get us back into that 8-12% range. So we'll see. Right now it's 7-9% kind of range we have out there, and we've got to work through to get higher than that, right? And we know that. And so that's how I would think about it. But the algo is still intact. And we will take incremental actions if we need to bridge this further to help get us back to that double-digit EPS growth.
Thanks.
And that concludes our question and answer session. I would now like to turn the call back over to Mr. Juan Peláez for any additional or closing remarks.
Abby, once again, nice job. Thank you, everyone, for participating in today's call. If you have any further questions, please feel free to reach out to me directly. Have a great day.
And ladies and gentlemen, that concludes today's call, and we thank you for your participation. You may now disconnect.